Hi, thank you so much for making time and speaking with us. First up, it'll be remiss of me if I didn't ask you about the total expense ratio, because that's the key headline at this point of time, which is expected to have an impact on the mutual fund businesses, on the AMC business. So if you could begin by just helping us understand what's your reading of this latest proposal and what do you think will be the impact on the margins and profitability of the various players involved?
Yeah, hi, thanks, Anisha. Thanks for having me. Yeah, this is probably the most significant event that's happened in a while, but it's been telegraphed. The regulator has made it aware to all the people concerned that they're re-looking at this. Uh, I think for a while now, we've been prepared to expect lower TERs. There's been pressure on performance over benchmark, et cetera, et cetera. And the way I would look at it is, it's a cliche, but what's good for the consumer is eventually good for the industry. And I think what we're really excited about as an industry is the long-term potential in terms of volume. So I think volumes will continue to grow, but at the margin, I think clearly there will be an impact on profitability, but it's something that I think we've expected for a while.
Well, not sure if it was expected for a while by other players, because for now the street is reacting negatively. So whether it's HDFC, AMC, Aditya Birla, AMC, all of these counters are showing a bit of a red tinge. But Anthony, also wanted your sense regarding what kind of impact are we seeing on the mutual fund inflows at this point of time, because the addition of demat accounts has slowed down. The SIP flows, which was at record high of over 14,000 crore, has also ebbed, and overall the retail participation was reaching a bit of fatigue. Would you concur with my view?
I would broadly concur. I'll just add some more color. I think if you look at especially the last 6 to 9 months in terms of flows, I think every month that you've seen a slight decline in the market, we've actually seen gross flows being relatively healthy. It kind of speaks, I think, to the majority of the retail investor. And every single month where markets have gone closer to new highs is when we've seen gross flows come out. So I don't think you're not seeing a change in the redemption numbers. I think investors are reasonably patient, but I think you're seeing I don't think it's about fatigue. I think it's more people waiting on the sidelines, preferring lower valuations. The other thing that I think we don't spend too much time acknowledging is that debt is a very credible alternative, right? Given that there is a view that interest rates have perhaps peaked out, and FD rates are probably higher than they have been for a while, you're seeing credible alternatives emerge, which I would say a year ago didn't exist. So I think a combination of the two means that for flows over the next 6 to 9 months, I think we'll continue to see a bit of tepid growth. SIPs, I have a slightly different view. Some of these numbers are just circumstantial. A year back, we had SIPs of 12,000 a month. Now we're at 14,000. I'm very convinced that retail investors' adoption of SIPs will only continue to grow, and I don't see market levels and stuff like that affecting that momentum.
Okay, so that's the take coming in, and debt, yes, is a very credible alternative. You're right, we don't spend enough time talking about that. But within the equity market, shifting focus back to that, where do you think the value lies? Because, at the start of the year, the mid-caps and the small-cap index was languishing. In fact, the mid-cap index is 21% away from the life high level, so quite a bit of distance that it needs to catch versus Bank Nifty, which is literally near the record high levels. Do you think it's time now to perhaps get back into the mid-cap and small-cap space?
So we're definitely seeing a large amount of interest from investors on small caps. Maybe not as much on mid caps, but if I was to order priority in terms of investor interest, I would say small caps first, mid caps second, and then a combination of multi cap and flexi cap funds. I think where we're seeing the least amount of interest is large caps. And I think small caps are seeing interest from two factors. One is, like you rightly mentioned, these are capitalizations that are probably most attractive from a valuation perspective. And the other theory I think that makes sense and plays out is over time, especially over the last 2 decades, when you believe that you're at the end of an interest rate cycle and interest rates will ease, it's tended to be good for smaller companies, for their businesses, for their earnings. And I think if you take the two in combination, potential uplift in earnings from smaller companies and the fact that you have relative valuation comfort, I think that's kind of what is showing us the traction. I would believe for the next, I would say, calendar 23, we will continue to see that play out.
Okay, that's the interesting take coming in of where the market interest is, because a lot of chatter around small cap, as you pointed out. But let's get sector specific within these, small cap space or even the broader market. Where is that you are seeing the maximum amount of interest or inflow happening as far as the sectors is concerned?
So if you look at the last, I would say 2 years, right? The sector that has contributed the most to earnings growth has been banking and financial services. And I think the play will now shift from the lenders to the borrowers. So while we've had good earnings at a headline level, I think the breadth of earnings has left something to be desired. I think we'll see better breadth of earnings. Uh, if you go by what I mentioned earlier, if rates are peaking out, we would believe consumer discretionary will continue to be something that one looks at positively. Banking and financial services, like I said, earnings growth has come through, but I don't think it's completely captured in valuation. So we remain positive on that. We like clearly the capital goods, building material space, given the government's emphasis on building infrastructure, etc. We think that will play out as well. I think at a broader level, I would just make a comment. I think in the last 18 months, we've been a bit of a value market. I think you're starting to see growth sectors make a bounce back. And that's where we're kind of looking at much more favorably. IT, pharma, some of the defensives, I think at best will remain a valuation call because there are clear headwinds in those businesses as we speak.
Okay, Anthony, on that note, we'll let you go. Appreciate you joining us on the show today.